All right, so let's jump into some of the practice problems together, and we're going to start with exercise 2-1, classifying manufacturing costs. So the costs below all relate to Sounds Good, a company based in Alberta that manufactures high-end audio equipment such as speakers, receivers, CD players, turntables, and home theater systems. The company owns all the manufacturing facilities, building, and equipment, but rents the space used by the non-manufacturing employees, accounting, marketing, sales, and human resources. So a required is, for each cost, indicate whether it would most likely be classified as a direct labor, direct material, manufacturing overhead, marketing and selling, or administrative cost. So let's work through all of these together. So the first one, depreciation, taxes, and insurance on the manufacturing facilities. So for this one is going to be manufacturing overhead. And the reason being is that we can't directly tie the cost of the depreciation, taxes, and insurance to any one product, but it does have to do with the manufacturing facility. So it is contributing to that overall production cost. So we would put that into our manufacturing overhead, which, as you remember, is just kind of a catch-all for every product cost that isn't directly traceable to the product. So second, we have rent on the office space used by the non-manufacturing staff. So this one would be an administrative cost. So I'm just going to put an A for administrative, and that's because the rent will be allocated based on the amount of space in the building to the different people, but none of it has to do with the actual production staff. This is just the general cost of renting the office space for everyone else in the organization. So this is an administrative cost. Next, salaries paid to employees who produce the audio equipment. So this would be a direct labor cost. It is the wages we are paying for labor that directly produce equipment that we are selling. So that would be direct labor. Next is the cost of the glue used to fasten the company's logo to the grill used in the speaker. So this one would again be manufacturing overhead. And the reason being is that the glue would likely be very low per speaker, like the amount they would have to use. So it'd be really difficult and not really beneficial for us to track. It's kind of an indirect material. And so we're going to lump it in with our manufacturing overhead. The next one, the cost of online advertising. So this is definitely a selling cost, selling or marketing cost. And that is because it has to do with the advertising, which is a marketing expense for our product. It doesn't have anything to do with actually making the product. So the next one, salaries paid to accounting employees. This would be an administrative cost. It has nothing to do with the actual product. It doesn't have anything to do with selling or marketing. It's just an administrative cost for the wages of these accounting staff. Next is the salary paid to the production manager who supervises the manufacturing activities for all the projects. So this one's a little tricky. So this one would again be manufacturing overhead, and the reason being that this specific production manager supervises all the manufacturing facilities, so it does have to do with the cost, the indirect labor going towards the production of the goods, and so it would get caught in manufacturing overhead. Next is the cost of plastic used for turntable dust covers. So this would be a direct material cost. So the plastic would probably be fairly easy to trace as it is used a specific amount for each turntable dust cover. There's something we're selling. So that is just a direct material. Next is bonuses paid to sales staff for meeting their monthly sales goals. So that would be a marketing and selling cost. I'll just put M plus S. So because it is related to the wages paid to our sales staff who do our marketing and selling, this would be a marketing and selling cost. And last but not least, the salary paid to the manager of HR. This would definitely be an administrative cost. Again, has nothing to do with the actual product. It doesn't have anything to do with selling or marketing. So this would be an administrative cost. All right, so now on to exercise 2-2, classification of costs as period or product costs. So Precision Electronics manufactures wearable devices that incorporate global positioning system technology. Their devices are used by runners, cyclists, golfers, hikers, etc. The following are some of the costs incurred by Precision Electronics, and here's a list of 15 items. So our required down below is to classify the above costs as either product, inventoriable, or period, non-inventoriable costs. So for the purposes of this, I'm going to say our product costs are I for inventoriable, and our period costs will be P. So let's start looking at some of these. So the cost of components used in devices. So this is going to be a product cost for sure. It has to do, if you remember, our product costs include our direct materials, direct labor, and manufacturing overhead, and the cost of the components used in the device would definitely be a direct material. So this is a product cost. Next is the factory heating costs. So this would also be a product cost. The reason being is that it's contributing to the production facility. It's a utility of the manufacturing facility. So it'll be captured in our manufacturing overhead, which falls into our product costs. Next, we have our factory equipment maintenance cost. This also would be a product cost. Again, factory equipment maintenance cost. It's the factory equipment is really the key thing here. So that would fall into our manufacturing overhead, and it is a product cost. So next, training costs for new administrative employees. So this will be a period cost. The administrative employees have nothing to do with the actual production, so it's going to go into our period costs. Next is the cost of solder used in assembling the devices. I'm not sure what solder is, but that is definitely a product cost. It sounds like a direct material. That would be part of our product cost. Travel cost of the company's chief financial officer. Now this would definitely be a period cost that has nothing to do with actual production. It's just an administrative cost of the CFO. Wages and salaries of factory security personnel. This would be a product cost. Again, the key phrase here being factory security personnel, the fact that it has to do with the production facility, will be captured in manufacturing overhead. Utility costs for the building used exclusively for administrative personnel. So because of that, it's the utilities for administrative personnel. This is going to be a period cost. It has nothing to do with actual production or the production facility. Wages and salaries in the department responsible for customer billing. So again, it has nothing to do with the production process. It sounds like it's accounting. So that is going to be a period cost, as it has nothing to do with the actual production. Depreciation on a fitness center equipment used only by factory employees. So this is a little different. Depreciation on a fitness center equipment used only by factory employees. So this is going to be a product cost. The reason being, erase that. This is going to be a product cost with an I because it has to do with the factory employees. It is manufacturing overhead because of the fact that it is related to the factory employees. The next one is telephone expenses for the manager of the production facility. This is again going to be a product cost. It has to do with the production facility. The cost of shipping devices to customers. So even though this includes the shipping devices to customers, it's not actually have anything to do with the product. It's just getting to the customers, which would be a marketing and selling cost. So that is going to be a period cost. The wages of employees who assembled the devices. So this wage would be a direct labor cost, which is definitely a product cost. The chief executive officer's salary would definitely be a period cost because it has nothing to do with production. It's an administrative cost. And lastly, overtime paid to the administrative staff in the accounts payable department, which is accounting, this is definitely a period cost and has nothing to do with production. All right, and moving right along to problem 2-17, so schedule of cost of goods manufactured, our income statement, and our cost behavior. So we're hitting a couple of the different learning objectives in this question. So we see we had the following information pertain to the most recent quarter at Precious Production Limited. So we have all kinds of information here about purchases of raw materials, direct labor, all kinds of the different terms we've been learning. And we'll see on the next slide what our requireds are going to be. All right, so our first required for this one is prepare a schedule of the cost of goods manufactured. So it's a bit of a beefy question, but not too bad. So if you remember from the presentation lecture, to get to the cost of goods manufactured, we have to move through a couple schedules first. So the first one we have to get through is the raw, again, please excuse my shoddy mouse work, is the raw materials. We need to do the raw materials schedule, and then from the raw materials we'll get our direct materials, which will take us to the manufacturing costs. Manufacturing costs. And then once we have our manufacturing costs, we can look at our work in progress inventory, and that is going to figure out our cost of good manufactured. So it's in this schedule where we're going to get our answer to the cost of goods manufactured. So first we're going to have to move through these first three. So number one is the raw materials. Number two, manufacturing costs. Number three, work in progress. So for number one, raw materials, we're going to look at what we have, our information, and we're going to want to pull out some of the information we'll need. So for raw materials budget, purchase of raw materials. So we're going to need to bring that over. Raw materials beginning inventory, we're going to want that. Raw materials ending, we're definitely going to want that. And then all the rest of these are not useful for our raw materials budget. So it's just these first three, the purchases of raw materials inventory beginning, and raw materials inventory ending that we're going to look at first. So as you can see, I started my first schedule with my direct raw materials. So I took the information we looked at last slide. So I have my raw materials inventory beginning of 40,000, which is right here. I brought it in. We're going to add our purchases of raw materials, which is $360,000 here. And we're going to add them together and get $400,000 for all the raw materials we have available for use. So this is all the raw materials we have to start putting into our products. So like I said, my ongoing example of the wooden benches, this is all the wood. I have $400,000 of wood sitting ready to be used. And so to figure out how much I did use during this specific period, so whatever this quarter was, if I'm trying to find the raw materials I used in production, my direct materials, I need to figure it out by saying, well, everything I had for use during the period, and then I need to deduct what my ending inventory was. So this is what's still sitting in my warehouse at the end of the period. So if I see everything I had available for use, and I deduct what I had left at the end, I should be able to see how much I actually used. So I had 400K available. At the end of the quarter, we only had 68,000 left. So in total, the raw materials we used were 332,000. And so now this amount, this raw materials used in production, will become our direct materials for the next part of our schedules, which is the total cost of manufacturing. So then our next step in this process, after we found our direct materials, and as you can see, our direct materials carried forward, so this 332,000 is the raw materials we figured out in the last step. So now we need to figure out our total manufacturing costs. And our total manufacturing costs are going to be our direct materials, which we have, our direct labor, and our manufacturing overhead all together, all our product costs. So we have our direct materials. Now direct labor, as you can see, I pulled up above. So our direct labor was here, and the total is 240,000. So we have added that here. And then next, our manufacturing overhead. So manufacturing overhead is going to be a little more tricky because there's so many different components. So remember, this is any product cost that is not directly captured in direct materials or in direct labor, but has to do with making the product come through. So it can be indirect labor, indirect materials like glue and wood chips and all that kind of stuff. It can be utilities related to the manufacturing equipment, depreciation related to the manufacturing equipment. Anything like that falls into our manufacturing overhead. So as you can see above, I went through the list. We pulled out some things. So our first one was depreciation for the factory, which is here. So this counts as related to the factory. So this 168 came in our list here. Next, we had our insurance expense, again on the factory. So because it's related to the factory, this is coming in as an overhead cost, or 20,000. Next, we had maintenance expenses on the factory. So right here, so it's up here actually, maintenance factory is 120,000. So that's coming into our list. Next, we had our utilities for the factory. So again, it has to do with the factory, the production unit, so we're bringing it in. So we have our 108 right here. We have our supplies. So again, this is our indirect materials, the glue, the whatever else is contributing to this production. So this supplies for the factory is coming in here at $4,000. Our indirect labor, so that's 260,000. So that can be the wages and salaries for the security or the janitors or the maintenance staff that contribute to the manufacturing facility. So altogether, these came to $680,000. So to get our total manufacturing costs, we add together our direct materials of $332,000. Our direct labor of $240,000, and our total manufacturing overhead of $680,000 to give us a total of $1,252,000 in total manufacturing costs. And so now that we have our total manufacturing costs, we can roll this forward one more time to the next schedule, which looks at our work in progress in order to determine our cost of goods manufactured. Okay, and then our last step is to find the cost of goods manufactured. We have to complete one more schedule, which is our cost of goods manufactured schedule or our work in progress schedule. So as you can see, our total manufacturing costs is coming in at the $1,252,000, which we pulled in from our past schedule. And then this is going to look a lot like our other schedules. So we're going to add in our work in progress inventory beginning. So this is all of the stuff we had already started to manufacture that was ready to go. And it's here, this 28,000. And then once we get this total of 1.28, we're going to deduct our ending inventory of 120,000, which was here. And so we're going to get our total cost of goods manufactured of 1.6 million. So we found all the costs that we actually manufactured this period. We added in all the manufacturing costs related to the work in progress we already had started at the beginning. So we got our 1.28 million. And then to figure out how much we actually manufactured, and what we mean by actually manufactured is what actually got finished during this period, we take away our ending to get our 1.16 million. So I just wanted to highlight the total flow for that first requirement again. So we started with our direct materials, and so all the information we've been pulling from that list of items from the first part of the question. But we first figured out our direct materials using that formula of beginning plus additions is the total available for use minus our ending is the total raw materials used in production, or our direct materials. And then we pulled down that amount here, which flowed into our total manufacturing costs. So that became our direct materials. We pulled in our direct labor and manufacturing overhead from the chart, and we got total manufacturing costs of 1.25 million. So that was our next pull in. And then to get to our next schedule for the cost of goods manufactured, we took this 1.25 million, brought it down to our total manufacturing cost. And once again, just the same as the first schedule, we took our total manufacturing cost, added it with our work in progress beginning. You'll notice we just kind of switched around the order this time, but it's the same idea of the beginning balance and the additions to get our total available. And then to figure out what we actually did during the quarter, or in this case, what we actually manufactured and pushed towards finished goods, we deduct our ending work in progress inventory of 120,000, and in the end, we got our end answer of 1.6 million. All right, so the second part of this question, 2-17, wants us to prepare an income statement. So I've pulled in some of the information. So this is all the remaining information in our blue table that we haven't used yet, which we're going to need for the income statement. So for all income statements, if you guys remember, first step, really important, really easy, make sure you put the name of the company, the fact that it's an income statement, and we always want to say for the quarter ending with whatever date it is. This is just the proper format to put it in. So our first step is an income statement is our sales. So as you can see, we have our sales up here. We always start with sales of 1.8 million. So we have our sales, 1.8 million. And then when we do an income statement in this managerial accounting format, we're going to have first, we always do our sales, which is here. We do our cost of goods sold, and then we get our gross margin. And gross margin, if you remember, is just our sales minus our cost of goods sold. So we're saying before we look at any of our other kind of expenses, selling, administrative, and anything, what is the actual money we're just making off of selling our product versus the cost it takes us to produce the product? So to find our cost of goods sold, which we do here in our income statement, which looks a little different than a normal income statement, but they prepared it all together. So our cost of goods sold, to find it, so we need our finished good inventory beginning. So this is everything we were able to sell at the beginning of the quarter. So you can see up here, our finished goods inventory beginning was 40,000, and we have that here. And then we're going to add our cost of goods manufactured. So if you remember from what we completed in requirement 1, this 1.16 million. So this is everything we manufactured during the quarter that's ready to be sold. So together we have our total goods available for sale of 1.2 million. To figure out what we actually sold, we'll have to take out our finished goods inventory of 160,000. So that's what's still sitting on the shelf unsold. So if we take that out, we know that our total cost of goods sold, which is this one right here, is this $1,040,000. So to get our gross margin, so our sales of 1.8 million and our cost of goods sold of 1,040,000, our total gross margin is 760,000. So that's how much money we made just off selling our products, just looking at the product costs. So now we have to add in our period costs, as you can see below. So we have our selling and administrative costs here. So our selling expenses up here, we have to add in of 320,000, which has gone in. We have to add in our administrative expenses, 280,000 for a total of 600,000. So if we have our gross margin of 760,000 less all of our selling and administrative expenses totaling 600K, our total ending operating income is going to be 160,000. So normally in an income statement, you won't usually see this cost of goods sold schedule broken out. We would just normally have sales, cost of goods sold, gross margin. But for the purpose of this question, they just figured it out here. So that's fine. That is our income statement. All right, so for requirement 3, it says, assume that the company produced the equivalent of 10,000 units of product during the year. So So I'm going to highlight that. So we have 10,000 units produced. What was the average cost per unit for direct labor? So as you can see above, I've pulled in our direct labor amount of $240,000. So to get our cost per unit, we are going to want to do, so for direct labor, cost per unit, so we want to divide our total cost by our total units. So we're going to have 240,000 is our cost, as you can see here. And then we're going to divide it by our 10,000 units. And it's going to equal a cost of $24 per unit. So that is the first part. So then next, what was the average cost per unit for factory insurance? So then for our factory insurance, we have a total cost of 20,000. So 20,000, and we're going to divide it by 10,000 units. And so our average cost per unit for the factory insurance is going to be $2 per unit. So there we go. All right, so let's look at the next requirement 4. So assume the company expects to produce 12,000 units of product during the coming year. What average cost per unit and what total cost would you expect the company to incur for direct materials at this level of activity? For factory insurance, note in preparing your answer, assume that direct materials is a variable cost and depreciation, which I think should say insurance, is a fixed cost. Also assume that depreciation or insurance is computed on a straight line basis. So let's take a stab at the first one. So what is the average cost per unit and total cost for direct materials at 12,000 units? Remember in the previous example, we had 10,000 units, and now, whoopsie, I want to highlight that. 1 second. So now we're looking for 12,000. We started at 10,000 for this year, so 12,000 for next year. So because our direct materials here is a variable cost, we know that the cost per unit is going to stay the same no matter how many items were sold. That variable cost, the activity does not change the cost per unit. So if at 10,000 units our cost was 332,000, our cost per unit must have been 332,000 divided by the 10,000 units from this year is 33.20 per unit. So that's our cost per unit. It will not change based on activity. So even if we sell 12,000 units, this will stay the same. But if we look at our total cost, so using 12,000 units, we'll now have to multiply our cost per unit of 33.20 times 12,000 units to get a total cost of 398,400. So as you can see, the variable cost, like direct materials, our cost per unit has stayed the same. It won't change at 10,000 or 12,000 units, but our total cost has increased with the activity. So now we can look at our factory insurance. So for factory insurance, at 10,000 units, we had a cost of $20,000. So our cost per unit, so I didn't actually include it here, but we can add it now. So if we look at our cost per unit before the change, so we had $20,000 was our total cost, and then we had 10,000 units. So our old cost per unit was 20,000 total cost divided by 10,000 units, which equals $2 per unit. So now we can see after this that with a new amount of units of 12,000, so now we have to do 20,000 divided by 12,000 because of fixed cost. The cost per unit for our fixed cost will change based on the activity. Our new cost per unit is now $1.67 per unit, rounded of course. So now it has decreased because our number of units has increased. So there's more to break up that total fixed cost. But you can also see at 12,000 units, our total cost of $20,000 remains unchanged. So to summarize, direct materials, when we change our activity level, the cost will go up, the total cost, but our per unit will stay the same. And then as you see below, when we have a fixed cost, like our insurance factory, as we increase the amount of units, our cost per unit will decrease, but our total cost will remain the same. All right, and for our last required for this question, assuming the company produced 20,000 fully and partially finished units during the year, determine the cost components of the finished good inventory, which is composed of 4,000 finished units. So a couple of things here we got to note. So now instead of the 10 or the 12, we're assuming that all of these costs we'd calculated are based on 20,000 units produced during the year. So what we're trying to find now is what is the cost components? So how much is the cost of our finished good inventory, which has 4,000 finished units, assuming 20,000 units were made during the year. So the way we're going to do this is we're going to assume that all of our manufacturing costs, so everything that goes into making our finished goods, is our direct materials, our direct labor, and our direct manufacturing, or not direct, our manufacturing overhead. These are all the components that go into our finished goods. And where we know they're all variable costs, we can figure out the cost per unit based on these 20,000 units and use it to find the total cost we'd expect, assuming 4,000 units. So if we take a look first at direct materials, so if we calculate our cost per units, we know our total cost at 20,000 units was this 332. So we're going to divide that by our 20,000 units to get a cost per unit of 1660. So since our cost per unit for variable cost should stay the same in the relevant range, which it is, we know that our total cost at 4,000 units should be our 1660 per unit times 4,000 units that are in our finished goods, which is going to give us 66,400 for our direct materials. So we're going to do the exact same thing with direct labor. So we know our cost per unit would be the 240 of direct labor divided by the 20,000 units produced under this assumption to give us a $12 per unit cost per unit. So to find it for the 4,000 units in finished goods, we'll do $12 per unit times 4,000 units to give us $48,000. So that's our direct labor. And so finally, for our manufacturing overhead, we'll do the exact same thing. They're all variable costs, so our cost per unit is going to be our $680,000 cost divided by our 20,000 units to give us a cost per unit of $34. To find the total cost at 4,000 units for our finished goods, we're going to do $34 per unit times 4,000 for a total cost of $136,000 for our manufacturing overhead. And so if we add up our 66,400, our 48,000, and our 136,000, we'll have a total cost of $250,400 for our 4,000 units in finished goods inventory. So the key to this is the fact that we know, if we know that these are variable costs, which we know direct materials, direct labor, and manufacturing overhead are, we can use the number of units, whatever it is, to figure out the cost per unit. And using that cost per unit, because we know it won't change for variable costs, it'll stay the same no matter the activity level, we can use it to find whatever amount of units we need to. So in this case, it was 4,000. All right, so that is all of the practice problems I'm going to go over in this video, but I highly, highly recommend you guys open up your books and attempt these other ones. So we finished exercises 2-1, 2-2, and we did problem 2-17. So I would recommend you guys try problems 2-16, 2-22, and 2-26. All of the contents from the chapter and all of these questions and questions like it are able to be on your assignment and on your test. So please practice them all. And if you have any questions once you go through them, please shoot me an email. Like I said, I'll be back on the 26th and we can address it then. Thanks, guys, and best of luck with your studying.